Thank you for joining us. My name is Andrew. Those of you that we haven't met before, and I'm joined by my partner Rick Grantham, and we're actually doing this from our Durban office. So yeah, nice to have someone else down here with us. And then also joining us is John Powell. John is one of the transaction executives in our team, who has, as it so turns out, has been working on a transaction which is quite relevant for this conversation. So format wise, we anticipate this will probably be about a half an hour webinar. And we're pretty sure that you'll get some good value out of it. There is a Q&A function below, so as we progress, please feel free to drop your questions in there, and we'll endeavor to either answer them on this webinar or we'll get back to you thereafter. Thanks for joining us, and let's kick off. Rick, quite a different format because normally you asking me the questions, so it's quite nice to be able to do this in the other direction. As a start, would you mind setting a context? Because we're normally quite generic in our approach, but it's one of the first times we've been quite specific around an industry. So maybe just set a context for all of us around why we're doing this today.
Yeah, great, Andrew. Thanks, and welcome everyone. I think it was quite an interesting experience of just over a month ago. In fact, not even a month ago, we had two inquiries at very similar times. The first one came from a South African M&A firm, and they were telling us about their buy-side mandate. For those of you who don't know, Deal Leaders is a sell-side advisor. We only work for the seller, but you get people who take buy-side mandates where they take a mandate from the buyer to go and find businesses which will fit a particular profile for their client. So yeah, we got a profile with very much IT technology type businesses. In their particular case, as said, EBITDA is between 10 and 20 million rand, and a fairly broad spec. Got us thinking we should talk to people we know in that sector and see who might be interested in progressing towards those mandates. And literally within a week, we got the same kind of inquiry out of the US. We've got a very good relationship with a buy-side company there in the US, and for the first time ever, they've got a client who's actually spec'd South Africa as a region in which they're looking to acquire, and it's similar kind of spec. Maybe I can talk through it. It's things like cloud services of various kinds, typical Microsoft service provider type companies. My other one is probably more interesting here. Things like, obviously software companies, data security, disaster recovery. So those type of businesses, very broadly, very, very broad spec on it. So that kind of opened our eyes. Now suddenly we thought, wow, this is interesting. We've got local and international. Interestingly, the international one doesn't even specify a minimum EBITDA. They would take 0 EBITDA, but they're looking at $5 million plus in terms of revenue. But yeah, that's quite a nice spec, and it includes a really broad range of businesses out there. And then the third one, which is a nice data point to fit in with that, is the experience we're having, which John is going to talk more about, with a software business in the market at the moment. And just fascinating to see that. Sorry, John, I'm going to steal a bit of your thunder here. We're in the crunch week. We've got, I think it's 7 or 6 offers, expecting one more today. So you can imagine the experience of getting 7 offers for your business, literally ranging from somewhere, I think, just north of 100 to mid 200 millions. And it's something that we often see this, where your range between lowest and highest offer is 50%. So your lowest is 50% of your highest. So yeah, we're getting this great experience in the market in real life, and we've got these people looking for businesses. So we thought, let's see if we can gather some people with these types of businesses and just talk through the experience, what it takes, what's important, what's not important. So yeah, good to be talking to this group, and we'll also be recording it so that we can forward it to other people as well.
Awesome. Yeah, thanks, John. I'm going to come to you now, but just one last thing, Rick. Obviously, we've done a number of transactions in this quite a broad space when you talk about IT or software, whatever. I mean, in your experience, it's a generic term, but there's lots of different types of businesses within this generic term. And often, we've seen over the years that sometimes I think, paint the same brush across the board. I mean, based on what we've seen and those types of elements, how does the market view these elements differently? Because they are very different, although they sit in one industry.
I think the types of businesses that these 2 examples are looking for, whereas John's deal is fairly different. In fact, they're quite broad-based businesses with quite a large client base and a multitude of services offered into that client base. So I get the feeling that these are These are situations where buyers are looking for client base as much as they're also looking for synergy, kind of cross-border synergy. It's a combination of both of those. Because particularly when you've got these regional plays, as people trying to get access into those new markets. I remember, Andrew, you were involved in the sale of an SAP business in South Africa, big client base, and that was sold into a company in Spain. Similar story, they were buying a client base while also accessing a new market. I think that's a lot of what the driver is here. As against more the tech businesses, which is tech and software, which is where John's playing, and that's much more of an IP play. That's where they're really looking for particular IP that they can go and sell into their market or add to their product suite. And those are typically narrower businesses, maybe a smaller client base, much more niche type of play, compared to perhaps these more IT type businesses are a broader play with a bigger client base.
Yeah, that's good. It's good, a good description. John, so putting you in the hot seat for the benefit of everyone on the call, do you want to give us a high-level descriptor, I suppose, a confidential one, obviously, about the business that you're currently working with? I think there's a lot of value in us delving into a bit more detail on it because it's real and you currently in the trenches. Just give us a quick overview on the business, and then we've definitely got a list of questions to ask.
100%. Afternoon, Andrew, Rick, and everyone else on the call. Thanks for making the time, and thanks for involving me in this process. Really appreciate it. Yes, to touch on that. So we've got a software business currently in the market. Like Rick said, we're in crunch week, so lots happening at the moment. But from a bird's eye point of view, it's a software business that happens to be in the ERP space, and they develop their own products that are seen as add-on modules to these ERP software, and it's real basic functionality products, but really robust, really effective, that is applicable across a broad range of industries, and can service any type of client as long as you have a finance function, that product suite can fit in there. So from a high-level overview, that's the best I can sum it up, but I'm sure we'll get into further details as we go along.
No, thank you for that. I mean, a very interesting dynamic, and I guess part of it speaks to the process we run is our ability to engage a lot of interested parties. Obviously, we go through a very robust research process. And the exciting thing on your transaction is there's been a lot of international interest as well. Why do you think that is? Because it's quite interesting. I've got a client in the mining services space, and a lot of the international interest is more around they can't manage from a distance. But it almost seems like there's a different set of rules in this space. Maybe just give us a bit of color around why you think there's been that interest and why it's a little bit different to our traditional clients.
Of course. Look, I mean, it's been an interesting theme, like you said, that we've seen so much international interest. I guess with software, tech, IT-related businesses, borders aren't that prominent. It's an intangible component, so one can obviously work across much broader regions with businesses like that, as opposed to physical on-premise businesses that have operating assets, moving on the ground, etc. So that's definitely something that makes this easier, that makes the software and IT play easier. It's been fascinating for us to see how these internationals have shown such tremendous interest in South Africa and the software assets coming from it. There's obviously a lot of factors that play into this, but dominant themes that we've seen is, put it bluntly, just quality assets coming from South Africa, quality products, quality IP, quality management teams. There's a big drive also and a big benefit from South Africa that there's highly skilled labor operating at costs that the first world economies just cannot match. So you can produce the same product, the same output at a fraction of the cost, which is really a big play. Needless to say, these factors, when combined, if you've got a good customer base, if you've got good recurring revenue, and so forth, it does make it appealing for any type of buyer, let alone internationals. But I do think that the buying power of the international prospect base also plays part into this. It is easier for them to afford a large check size, just plugged into, like Rick mentioned earlier, these geography plays. If there's a quality asset in South Africa or a quality software business, these internationals can easily plug it into their international networks, and they can grow it, they can scale it. They've already got that component working in their favor, being a software or a tech-related business, and they're really good at it. We've seen a theme come through with these internationals that they are significantly better at growing these international geographies, growing these markets and these plays than what we've seen with South African counterparts. So
Mm.
it really is a win-win situation for them to plug in those businesses into their larger networks. Thanks.
No, that's really good. Rick, I think, over the years, and based on the grey hair, we've been doing this quite a long time. The million-dollar question often is, how do you value these businesses? And there's always this, we typically work in an EBITDA world. There's multiples of revenue based on certain types of products. I mean, John, I'm going to come back to you because I want to know how the market has valued your client's business. But just what are the challenges in this space? I think for anybody, who's operating in this business and, doesn't really know how they think they know what they want, how does the market view these types of assets when they're putting valuations forward?
Yeah, it's a good question, because we went through a period where we took on quite a few tech businesses. We had a bit of learning to do, and I think the key learning was around this belief, and you could even see it in the spec from the guys in the US, that because I'm tech, I don't have to make profits. I'm going to get a multiple of revenue. The valuation is going to be based on my revenue. It's not really true. I think there is a world where, put it this way, if you want to get value for a business, it must either be, if it's not going to make profits, it must be growing fast. In other words, it is making profits, but you're reinvesting those profits into growth. Mm. Then you're into that revenue and annuity revenue. You can get that multiple of revenues. Or you must be making profits. If you're making profits, as the South African buyer was saying, between 10 and 20 billion is a good number of sort of EBITDA. But don't think you can do neither. You can't have a flat business and not make profit. You're not going to get that. That is a critical piece of it. Even though something that we have found is there's a general acceptance of the idea of basically capitalizing development costs. So that's a very important thing for anyone with us, particularly where there's a lot of development involved, a lot of software involved. There is an acceptance that you can justify that a portion of your development costs are towards building the asset. In a different world, you might have capitalized that and depreciated the asset. There's an acceptance that you can do that. So there is a world to add some back. But if you're building the software, but it's not generating the revenues, so you kind of all of your profits are in add backs, well, it's probably also not going to work. But I think those are the two main things. There is more of a tendency in the tech world to pay on multiples of revenue rather than multiples of profit. But once you're in the profit world and you are making decent profits, I think it's a much more comparable number to look at multiples of EBITDA or pre-tax profit rather than looking at revenues. I think revenues get a bit confusing, particularly, in fact, if you take the case of the business that John's working with, where the margins are incredibly high. It's almost a 50% EBITDA margin. You'd actually rather have a good multiple in EBITDA than you would on revenue, because your revenue multiple suddenly has to be so massive because of those very, very high margins. I think just another interesting point on valuation and also how people see value is, I think that what's interesting there is that in John's case, the local offer, and I think we only got one local offer in the end, was literally half of anyone else, or half of the kind of really serious international offers. And that demonstrates that it's the international, all the growth for that particular business is international. They're doing well in South Africa. They've got a certain growth rate, but clearly they don't have that ability to go and sell this product in the US or in Europe. And the acquirers believe that they can grow it. So clearly what they're doing, they're valuing a fair amount of what they're going to bring to this business. And that's really what you want to do. And if you can create the right amount of deal heat, one of our signature elements, a bit of tension, not being an auction, but being a competitive process, that's when you get people to pay for a bit of the future. There's no doubt a few of these guys are seriously paying for the future that they're actually going to bring.
Absolutely. I mean, John, to get back to you, thanks for that, Rick, you're on 6, you're about to get the 7th in. So clearly there's a real hunger for good assets in this space. And the questions just come through. Rick, as you've alluded to now, there's almost like a 50% difference between the lowest and top offers. And the questions around what is the average we achieve at a multiple level. Do you want to unpack from your perspective now, how has the market valued this business, and what's driven that? And then hopefully we can give the individual that asked the question a bit of a steer, but I'll pre-qualify because there's no average and it always depends. Sound like an economist. But yeah, maybe let's just make it a real example with this current transaction.
100%. We've been fortunate. We've seen fascinating results come through with this valuation. I want to add on to what Rick mentioned about deal heat and the fact that we don't run auction processes. I think our designed model allows us to get pure offers, pure valuations based on what they believe the value is, versus where in an auction model, you just want to be one higher than the guy in front of you. We're fortunate in that we don't have that distorting or smudging what we have as valuations coming forth. So we've also had a range of buyers that represent funds, private equity funds, software conglomerates, buy and hold groups, investment holding companies, and then pure strategic trade players. In other words, not competitors, but players that also offer software products of their own, where it's a pure strategic place. We've been fortunate to have this broad spectrum really coming together, and each of these giving what they believe are fair offers and valuing obviously based on what they believe drives value. A lot of things that drive value. We've also seen, Rick mentioned, the strength of your revenue, your streams, your customer base. There's a lot of things such as, your customer attrition that they look at, and not just customer retention, but attrition as well. There's those factors are all things that they take into account. They really place emphasis and value on it. And when these things come together, obviously the strength of your business grows. And our range that we've seen has really been fascinating. Like Rick said, it's been half on the lower end of our scale. We had with I suppose in some way a bit more expected with private equity funds. They do value differently, coming in just below a 6 times multiple on EBITDA. And on the upper end of the scale, we saw these pure strategic player come forth with an offer that was more than double that. Needless to say, the structures also with these valuations, oftentimes the lower valuation is, the simpler the structure is, whereas the higher it is, oftentimes it's more complex, which is exactly what we saw in this case. It's not always guaranteed to be like that, but we saw it play out like this. So there's a fascinating range of offers and structures that we saw come through in this particular process, which really has made it interesting. It also gives us a lot of insights into the market as to what to do with this going forward. How do we use this going forward on more deals, more transactions, how to obviously position things that we've seen the market values, and to play that to our client as the seller to their advantage and generate the best deal heat that we can.
Absolutely. And I mean, that EBITDA multiple range, if you were to just do a cigarette box calc, I mean, if you're at a 12 times or, 6 to 12 times EBITDA, what would that equate to at a revenue level? Multiple.
Revenue level, it's quite high for a revenue level. If I take this current example, it would be probably around 11 or 12. So from a revenue perspective, that's relatively high, but that had a really different structure. There's a lot of upside worked into that. To answer your question, it's relatively high. Usually you would find, we got a lot of these insights and feedbacks from the market, that usually you would find the market expects and applies anything from a 4 to a 7 times revenue EBITDA multiple. Revenue multiple. EBITDA obviously has different numbers.
I mean, a very important point you've just made there, and Rick, to come back to, we are seeing more and more value is really important, and we can speculate, hopefully that answers the question of what an average revenue multiple or EBITDA multiple looks like. But the structures are becoming as important, if not more important. So maybe a little bit of color around that. It's not only about the value.
Yeah. No, I mean, in fact, we've in these conversations, we've been discounting one of the offers altogether because it's basically a share swap with a potential value of 700 or 800 million. The risk is way too high because there's zero upfront. There's no risk-free portion. A number of them came in at more like 50-60% upfront, but the winners are clearly in that 75% cash upfront, and that's the top 2 deals are in that range. And then there's some structure on the balance, and we pride ourselves on doing very few earnout deals at deal leaders. We generally find a way around them. We've still got some work to do on these. There's an element of earnout in that last 25%. But we've had some good conversations, particularly with the one buyer, where there are quite a lot of ways to mitigate the risk in that. And this is the thing with earnouts. So you've got to tackle them head on. We've already identified ways that we're going to manage that through the finalization of the deal process. You're handing over control, and you're now living in a world where someone else is actually running this business, but you're being measured on their performance, even though you're technically still running it. And they always tell you, no, don't worry, we won't get in the way. You do it yourself. You said that you were going to do these numbers anyway. This should be easy. All of these standard comments come out of buyers. It's a different world, so you've got to make sure that they're not going to add risk to your environment. You've got to somehow a base into it or an agreement. You've got to pre-agree how this number is going to be calculated. Can you rather get it on revenue rather than profits? Because revenues are more difficult for someone to mess with. Profits are easy to mess with. You just have to pile in a lot of costs, and you're going to hit your EBITDA. So that is an element of it. But we generally, this just going to where I started, this idea of getting paid in shares, highly risky. Too many things go wrong with even the best companies in the world have disasters. They have shareholder disputes. They have all sorts of things which you've got no control over. So shares in someone else's company, I'd rather have shares in my own company than someone else's, or cash in my pocket, I think is really what it's about.
Absolutely. Quite an important part of any market approach. And what brings up this next question for you, John, is, we part of an international network, for those on the call that don't know, called Pangaea Global. And Rick and I were on a Teams call the other night with the whole group, and there was a new partner who's come in from Israel, are 100% focused on this space. And the thought crossed my mind that when we're approaching these buyers that we identified in this transaction, they are looking at opportunities from all over the world, and they're being inundated by all these guys. So clearly, an important part of what you did was package it correctly, interest, and so in your experience, how important is that? You can have a phenomenal company, but how do you tell someone it's phenomenal in amongst all this clutter of all of these other opportunities out there?
Yes, Andrew, we've received a bunch of good feedback from the market, which reinforces the fact that we package it well, which was obviously always good to hear. We try to be as succinct as we can when we package this information, to be very specific on crucial aspects, margins, which is annual recurring revenue percentages, etc. There's a lot of preparation work that's done on ensuring that strategically you address the right components and then package that in a nicely designed information pack. Even despite as best as we did with that, we still received a lot of queries from the market. I do believe that in many ways, the number of queries that you receive from your information pack is an indication of how well you've packaged what they need to know. We've also seen that, for example, it is important to be explicit. It's easy in a software or tech world to get the wrong idea, jump to the wrong conclusion if you aren't articulate enough. This really builds trust and favor from the prospect side. If your information pack is prompting too many questions, they tend to lose faith in it. If it does the opposite, for example, they have specific queries, but not overly, number of additional queries, then obviously you've packaged it well, and trust builds. And from there, they really start the conversations that lead up to them submitting an offer. So there's a whole different dynamic behind that, but it is important to package it correctly. You don't want the buyers to sit and wonder about certain aspects. You want to effectively provoke these questions that you want them to ask, and you design your information packs in such a manner so that you give them just enough that they understand the basics well, and from there, out of their own, start prompting the questions, because that's in effect how we cull through the buyer list that we work with. If you're working with a big buyer list like we did in this instance, you have to find some dynamic and efficient way to get the parties to draw the line relatively quickly. A good information pack obviously achieves that.
Now, just on that note, how big was your prospect list? And for those on the call, that prospect would be potential buyers. How many targets did we approach?
So we started off with somewhere just north of brainstormed prospects that were just north of, I think, 450. We started with a really big pool, and we systematically funneled them down with relevant insights, looking at who's more appropriate than the other. We ended up with a final list of 127. I think you and Rick will probably be better placed to compare against our other projects. That is a big list in many ways. It's a lengthy list. With this instance, obviously having so many internationals, it made our market engagement phase longer than it usually would be. The time zone differences are quite a challenge, but the market is so much bigger, so much broader. We had to throw the net relatively wide. Thankfully, like you said, with the offers that came through, we had a good hit rate.
No, well done. Rick, I mean, on that point, there may be some people on the call are thinking, well, 127, it's like total overkill. Why is that number important? It's not about the hard number. It's more around casting the net really, really wide. And I think this is a great example of it. But why is it so important to approach so many people?
The key thing, and I suppose it's something that we continuously striving to get right, is there isn't a predetermined number. The number is the number. You don't want to not contact someone who might have been a good buyer. And for some industries, in some sectors, we'll contact 25 parties. This one is quite on the high end, 120 something. Others might even contact more, because you don't want to risk that, wow, that looks like a really good acquirer, but we've already got 100, so we're not going to go any further. And it's one of those skills of a really good researcher, is knowing when the list is complete. As a starting point, there's no predetermined number. I think what is important, though, is the logic that we use to work out who to approach. Let's not forget, we've now got a nice bunch of good acquirers already lined up for for tech companies. So, that's going to help. But we'd always be quite cautious not to just go to the parties who've said they're looking to buy. So we always want to broaden it anyway. And the way we do that is by creating categories of potential acquirers, so that you're not just broadly saying who's going to want this, and maybe these guys, maybe those guys, but actually break it down into categories of acquirers. So in this particular case, one of the categories was the other companies that sell products into the same kind of software ERP platform. Another category might be completely different software platforms, which might want to get into this particular platform. So there's a kind of complementary nature to it.
Mm-hmm.
We tend to avoid direct competitors. Direct competitors don't make great acquirers. It's very hard to know what to share with a direct competitor and when to share it. You find trust breaks down quite early. So we avoid the pure competitor space. We've got a very structured way of getting to that list. You can't just sit around, John referred to the idea of this brainstorm. That doesn't mean we just sat around and came up with 400 names. We created the structure, go and do some very broad research, pull them in, then we label them as brainstorm because we haven't really done the thinking behind it. And then we go to a line by line exercise to get through to work out each one and kind of build it from there. I think the key thing here is some lists are going to be very short and some are going to be very long. I suppose what the other important element is the fact that we've got the kind of machinery in the background to manage 126 prospects. That's a lot of prospects to manage. We've got to contact every single one. We've got to get a response from each one. Our client wants to know why XYZ company said no. So our database must have that information so we can go in. In fact, we even give our clients a link so they can themselves go into the project and say, well, why did whatever computer company, wherever software company say no to my lovely company? Oh, there's the reason. It's captured there and it says strategically they've decided not to focus in the sector or whatever. So it's that ability to manage it is really important. And we are able to, a list of 126 we got through incredibly quickly. If you take too long, you don't create deal heat. If you don't create deal heat, you have a complete mess in your hand. If you get 7 offers over a period of 2 months, you might as well get 1 offer. It's impossible. You've got to get your 7 offers over like a week or 2, which is what's happening.
Absolutely. In the interest of time, so there's one more question that I think is probably relevant to answer. I'll start with you, Rick. We see it a lot, particularly in this space, where somebody has either got someone at the table already, or there's the obvious 5 that one of the 5 are going to buy them or whatever. How does this typically show up? It's often someone we see, I don't want to run process because I've already got someone at the table. Or in a situation like this, there's going to be 5 at the table in 12 months' time or whatever that number is. How does that play out for us and the process and obviously the clients we work with?
Well, you and I have had the same experience here. We've never been right. And our clients are never right either. So when invariably, I don't think I remember a case ever where the client came to us and said, I've got the buyer. Because we always say, cool, let's try and sell to the buyer. And it just kind of falls over, partly because that buyer was pleased they had you on their own, and they thought, I can pull off a cool deal here because there's no competition. Oh dear, deal leaders involved. I'm going to have to put my best price on the table. I'm not willing, I'll back out. And we bring other quality buyers who shame that guy because they bring in quality offers. So when I say we're never right, just maybe explain that better. It doesn't sound too good. But the reality is it's really hard to predict who the best offer is going to come from. If we went back to John's project, the guys who we thought were slam dunks have made rubbish offers or didn't make offers at all. It's just somehow when you do it properly, you realize that there are more buyers out there and you don't want to narrow things down, you want to broaden them. The timing is huge for buyers. You'll find a buyer was an absolutely keen buyer 2 months ago. In 6 months' time, they might not be a buyer anymore. They might have found something. They might have found something similar. One of our recent mantras is time is a killer. So you go in hot and you deal with the market as the market is right there and then, and you move as fast as you can through those offers and get to a deal and close the deal and close it quickly. Because there are just too many factors that you can't control and you can't influence. So, I think the other big thing is, we talked about add backs and software development and how you can kind of call that part of your EBITDA because you might have capitalized it. Some acquirers are going to say, absolutely, we're quite fine with that. Others are going to say, not a chance. You didn't capitalize it. Your problem. You don't know which one's going to see it which way. And the problem is that in the early stages, people are quite positive. I've been very close with John on these offers that he's got. You talk to them about valuation ranges. You talk to them about where you're trying to get to. they're all positive, and then they make a rubbish offer. Yeah, because actually in their world, they've looked at it carefully, they've used their rules. Everyone's got different rules around these things, and it just doesn't come out like you thought it would. They're fine with it because they say, well, this is how we value this thing, but it doesn't meet what our expectations are. So again, you've got to go broad enough. 5 is never enough. As if you want the blunt answer, 5 is not enough, because the chances of none of those 5 really being right place, right time, right valuation, right everything, the chances are pretty high that they're just not there. And I think we always find that the lists we put together have got a huge number of surprises for buyers, for sellers rather. Our clients say, geez, we thought there were 10, you found 100. It really does change the picture because of that ability to research in real depth, particularly internationally, and makes a massive difference.
No, absolutely. John, just the one thing that we often look at, and an important part of what we do is we do a lot of valuation work. I'm going to put you on the spot again. We don't take a value to market. So often there's examples where we've invested X or we've development costs of Y, and then we need to add whatever it is to that to get to a value. You've got a classic example of how the market has priced the asset and that spread. What do you think would have happened had you taken a price to market? Because I guess that's the $1 million. You kind of understand what's the emotional number and the valuation work we do, and then you compare it to what actually happened in the market. This isn't a performance review, by the way, so you can be quite open and honest with
I
it.
thought that's a bit of a trick question there, John. Good luck.
Yeah.
No, I've got a good answer for this. I've got a two-pronged answer. So initially, let's talk pure technical valuation. So when we did our first valuation, we obviously use a number of methods, DCFs, multiples. There's a bunch of methods we use, and our general overlapping range came to, an amount round about, 180 million roundabout there. That's one leg. When we exactly what you and Rick just touched on, prior to this question, when our client came to us initially, they already had an interested party at the table who had offered at that point a much lower multiple, and the value came to around 110, 120 million. So between these two initial values is where we started. The one obviously on the lower end was a closed loop, one buyer courting the seller. This is what they were prepared to pay. Our evaluation later on, which was an inherent reflection, just technically based on what the cash flows and discount rates and all of that would yield. When we then went to markets, the values were significantly higher. A lot of the offers came in at least 30, 40 million higher, than what we thought, obviously excluding that share swap transaction. All of that is still in the process of discussing, clarifying, negotiating. There are still aspects that we could possibly uplift. So to answer your question, if we had gone with either of the two values to market that we had initially had with us, we would have fallen short by a tremendous amount, and it would have been a complete lose-lose situation for the client. So because of this, we've seen it time and time again play out. Because of this factor, we deliberately don't do that. And we get the prospects. I had almost every single prospect asked me, can you give us valuation guidance? Can you provide more detail on the number, etc.? And we have to really ensure that we navigate those situations carefully so that we can give them enough information to make their own assessment. But at the same time, also, if they do keep pressing for numbers, we give them ranges that we know is acceptable in the market. And we had all of those, all our offers fell within those ranges. We are really good at steering and guiding valuations, but we never go to the market with an actual value. It's never successful.
No, that's great. Thanks, John. Okay, so there's one last question, Rick, and then unfortunately, time-wise, we are going to have to end. And again, thank you to everyone for your questions. I think a very relevant question, this last one from a lot of business owners in this space is, how do businesses and business owners position themselves from an understanding perspective? What is the business worth? What's good? What's bad? Whatever it may be, even if they're not ready to sell now. It's a very important step. But, in that situation, we're seeing a lot of it. I mean, how do you work with someone like that, and what are the options?
Yeah, listen, it is something that we've spent some time on this year in finding better ways to assist companies that either they think they're not ready or we think they're not ready. We've certainly had examples where people come to us and say, sell us, and we look at them and say, no. In fact, even if I look at this business now, I met this guy 4 years ago and he hadn't drawn his first dividend from that company yet. And I said, no, clearly you're not ready now. Let's get some dividends, enjoy the business, get some growth out of it, and then we'll look at it later. But what we didn't do then was help with that roadmap. So now we've developed a sort of intervention where we help people understand the value of their business. We help them understand the drivers behind that value that we're currently seeing. So kind of what are the levers that they could pull to improve it. Also help them understand which are the buyers that we would look at for that particular company. How would we approach it? The magic of what we do is this ability to think quite laterally around where we would find the buyers. So you add that to, this is where we see your value at the moment. These are the type of buyers. And by the way, these are the factors in your particular business which we believe will push up the price. And on the negative side, these are the factors that are going to pull down the price. So to simplify things, what's a roadmap going to look like? Well, do more of this and do less of that, and see if you can and build your roadmap from there, because there are a lot of good things that people can do early on. A lot of it sits in margins. A lot of it sits in where people put their energy behind development, and actually in marketing. I still to this day believe that South African companies don't spend enough marketing their businesses. Marketing and managing sales properly, building proper sales pipelines, and being able to talk to their sales pipelines, being able to talk to the quality of their forecasting. So there's a huge amount people can do if they're not ready. If they are ready, they need to do it now, because we're in quite a nice time we're in a nice cycle in this country. It's not going to last forever. It never does. And strike while the iron's hot. So I really think there are a lot of businesses that are probably more ready than they realize, and that's cool. But we will never. I think something we've learned over the years, we will never say just let's go to market just for the hell of it. If you're not ready, we're going to tell you you're not ready. But come and do the assessment, I think, is the important thing.
Awesome. Well, thank you, Rick. And so that brings us to the end, a little bit over as usual. But I think a very, very good discussion. And thank you to all of you for attending. And John, thank you very much for your insights and well done. Good luck on that 7th offer. But outside of that, it's still looking great. So and Rick, as always, thank you very much. It was a pleasure. And to those of you that had questions, thank you. But also, we will have a recording of this. And please, if you have any further questions or any insights you would like, very happy to share, and be great if at some stage we can have a cup of coffee and discuss a way forward. But thank you to all of you. Hope you have a good afternoon further, what's left of it. And we'll hopefully see you on our next webinar. All the best.
Cheers, everyone.